Hello ladies and gentlemen, welcome back to C.A.R. Entertainment. My name is Dylan Hamilton, guys, and today we're going to be starting our A22 Business Studies revision, guys. So, we want to start off with taxation. Now, this taxation, when I was taught it, came a little bit later in the lifespan. We started off with macroeconomics and go through. We'll get back to that and we'll go through it, but I just want to start off a wee bit about taxation, because taxation is probably one of the most necessary things you need to learn about in life. And I think getting this out early may help a lot of people with their future plans and all, because everyone has to pay taxes. Although it doesn't tell you directly how you pay them, etc., it's very, very useful to know and will be incredibly beneficial to you as a person. So let's get straight into this and talk about tax. So, why is tax needed? A tax is required by a government to raise finance for government spending. This is why people are taxed. It is also needed to manage the demand in the economy. So it helps the government macroeconomic objectives, which we'll go to whenever we talk about macroeconomics. It will change the distribution of income and wealth, and it will address market failure and environmental targets, such as taxes being used to help correct market failures. So, two different types of tax. There's indirect taxation and direct taxation. Indirect taxation is a surcharge on a price that is imposed on a sale of goods and services by the government. Therefore, taxes on expenditure. So, for example, VAT, which is value-added tax, taxes on alcohol, tobacco, and petrol. Whereas direct taxation is taxes on income, and this is the main direct tax in the UK. Basically, you may not know if you are working for a company, because that company will undertake your income tax directly. They'll take it out and pay it for you. But if you run your own business, then you'll have to do this for all of your employees. So income tax. Income tax is tax that is paid in wages. If you have lower disposable income and the rates increase or personal allowance are reduced, this will reduce customer spending. So essentially, if income tax increased, then you're going to have lower disposable income. Okay, so if the rate increases, lower disposable income, reduce customer spending because you have less money to spend. Business will act as tax collectors and pay this income tax on the staff's wages, representing an administrative burden on the business. This is what I just talked about. So in the UK, you have 20% tax from £11,851 to £46,350. You'll be taxed 20% on that number. You'll be taxed 40% on the number from £46,350 to £150,000, and then 45% for anything over £150,000. So then, value-added tax. So this is VAT, more or less, we'll just shorten it to. So this is an indirect tax which is levied on the sales price for most goods and services. Consumption tax is borne by the customer as they pay a fixed percentage of its final sale price. Now in the UK, this is included in the price. In the US, it isn't. So I'll use a US example. If you buy someone that's worth £100, they might have a 10% VAT on that, and therefore you'll pay £110 at the till, but it'll be advertised £100. So you need to know value of the tax and add it on yourself, etc., before you buy it to know you have enough. So VAT is not collected in full from the final seller. The seller will deduct VAT liability on the amount of tax that has to be paid of all VAT and the registered business up the chain. So this essentially means if you're using indirect distribution, if you have to go for the wholesale or whatever, you will not, the final VAT will not come from the final retailer. Essentially, it will come through back to the business up the chain. So value-added tax is placed on expenditure. It will increase cost of production, causing an inward shift in the supply curve. Refer back to demand and supply from AS. The distance between the pre-tax and post-tax shows the tax per unit. The supplier can pass a value-added tax on as higher prices. This is known as shifting the burden, and it will depend on the price elasticity of demand and supply. The standard rate is about 20% in the UK. Customs duty then is what's charged on gifts and other goods that are sent outside the EU if they're above a certain value. The value will include the price paid for the goods, postage, packaging, and insurance. Between £131 and £630, it's about 2.5%, but if it's over £630, the rate will depend on what type of good it is. You know, excise duty, which is whenever you send alcohol or tobacco out in the EU or send from the EU, and if it is sent from the EU, then you have to check that excise duty is included in the price. If not, the goods will be seized. The goods are seized essentially if you send spirits, which are over 35 centilitres without a UK duty stamp, tobacco without a UK health warning or fiscal mark. So why do businesses use indirect tax then? Well, the arguments for using it is that it can change the pattern of demand by varying relative prices, and it's less likely to distort choices between work and leisure, having a less of a negative impact on work incentives. It will also change more easily than direct taxes, giving policymakers more flexibility, and indirect taxes are less easy to avoid. So why not use indirect taxes and tax between countries? So arguments for against using indirect taxes. Well, a higher indirect tax will cause cost plus inflation, which will lead to a rise in inflation. We'll talk about inflation in its own separate video later on as well. Revenue can be uncertain when inflation is low or a recession will forms, causing a fall in consumer spending. Again, we'll talk about business cycles, recession, and all that here later on as well. You'll have a loss of welfare from duties, and higher indirect taxes will affect households on lower incomes who are least able to save. So tax competition between countries. This is whenever a national government will reform to a tax system as a supply-side strategy, attracting investment and jobs into their economy, which is a tax burden measuring the total tax revenue as a percentage of GDP. Supply-side strategies come under the monetary policy, sometimes under the fiscal policy. We'll talk about this later when we talk about those as well. So, corporation tax. And corporation tax is whenever a limited company, a PLC, is required to pay based on their reported profits. The reduction acts as an incentive to undertake capital investment or reinvest in a business, but if you increase corporation tax, it makes it unattractive to undertake investment or trade in the UK, and therefore it is difficult to attract foreign companies to invest in the local economy without additional tax incentives. There is 19% in the UK, 12.5% in the Republic of Ireland. The effects of increasing and decreasing government expenditure. Well, increasing it, you'll increase demand. The government grants will pay awards greater than the level of inflation, which will increase disposable income. And the spending of additional income in the economy and will undertake specific infrastructure projects, increasing business activities, and industries will be indirectly related to them. If you decrease it, then the government expenditure will lead to a contraction of public funds available, and disposable incomes will be lower, with smaller amounts of public funds available, reducing spending. Thank you for watching this video on taxation. Hopefully you all have now a better understanding on it and can answer a question easily on your exam. I've been Dylan from C.A.R. Entertainment, and I will see you next time.